Tech's doing pretty well, too. So what's your perspective here on all that's happened and what you think it means?
Look, I think SVB, they were the hearts and lungs of the banking community in the Valley. I think the ripple effect here is going to be significant for years to come, because ultimately, from an early stage and even mid-stage financing perspective, it's going to put a lot more pressure on these companies, and I think that's really the story here in terms of the ripple effect.
When you think about the kinds of companies that you cover, generally speaking, the larger tech ones, does it have any impact whatsoever on your projections for what their earnings could be, whether the stocks are as attractive today as they were a few days ago?
Well, I think, look, there's about called 12 to 15% of the end user base. When you go from Microsoft down across software, you're selling to startups, early stage, mid-stage companies. And I think that's something right now. The worry is, okay, if some of those go away, they can't get financing. No longer the daddy warbucks of Silicon Valley in terms of, SVB. Now you can't get those loans. You can't get that venture lines. What does that do? We believe ultimately it's going to lead to haircut and valuations. M&A is going to be accelerated, and I think really the clock struck midnight here. I think this is a big change for potentially a decade that we're seeing in the Valley.
When you say, I want Mike's response to this too, when you say haircut valuations, for who are you talking about?
Yeah, I think for a lot of these companies still walking around with hubris in terms of where valuation was, I think ultimately this is a game changer, because right now, from a venture line funding, that essentially goes away. Now you're going to have to seek alternative financing. VCs are going to have to ultimately tighten the belt on a lot of their startups and portfolio companies, and some are going to be left on the outside looking in.
Mike?
The process has been underway. I wouldn't be surprised if this accelerates it. Most of these companies are, they're equity financed for the most part. It's not like they're massively leveraged, but it has everybody looking at the things they were already looking at just harder. Cash burn rates. What are your relationships with the risk appetite for that? Backing any new or young company is probably a higher hurdle right now. I think from a public investor's perspective, you might have to make tweaks around the edges, but I think it's the stability of the very large, giants of the NASDAQ that matters more in a moment like this than whether we're going up or down a nickel in earnings per share this year.
But you think that, Dan, money from investors could move away from some of those companies that you're talking about and only strengthen the investor base, so to speak, of the Microsoft, the Apples, et cetera?
I think the strong get stronger. And I think ultimately Apple could potentially more aggressively go into on the banking side. And I think from an M&A perspective, you're going to see right now an acceleration of M&A coming out of that 415, 408 area code.
All right. It's good to see you. Dan Ives, thank you for being here.